This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 27, 2026, and this is the After Hours session. Now, let's get into it. Global risk appetite has evaporated. The Fear and Greed Index has plummeted to a deeply fearful 14 out of 100, signaling extreme capitulation among investors. As capital flees risk assets, the US dollar is surging as the primary beneficiary, with the trade-weighted dollar index reaching 120.71. Meanwhile, gold is clinging to its 5-day high of $4,166.12, caught in a tug-of-war between physical demand and bearish institutional positioning. We are live at 1914 ET on Monday, July 27, 2026. Looking ahead, the market's eyes are locked on two central bank decisions that could redefine the currency landscape. First, the Federal Reserve's FOMC rate decision drops on Wednesday, July 29. This is the pivotal moment for U.S. monetary policy, especially given the sticky inflation data we've seen recently. Second, just one day later on Thursday, July 30, the Bank of Japan releases its BOJ rate decision. The tight spacing of these events creates a narrow window for volatility, particularly in the dollar-yen cross.
And here is what to watch for regarding the FOMC. With the 10-year to 2-year yield curve flattened to just plus 0.34 percentage points, the market is pricing in a delicate balance between fighting 3.46% CPI and managing recession risks. Any deviation from the expected hold at 3.63% could trigger immediate repricing in the dollar.
Let's set the scene. Equities closed mixed on Friday, with the Dow edging up while the Nasdaq faced continued pressure, as noted by reports that Nasdaq shares remain under pressure and the S&P moved below its trendline. This equity weakness mirrors the FX market, where risk-sensitive currencies like the Australian dollar are struggling. Aussie dollar traded at 0.69993, barely holding onto gains, while JPY sat at 1.9079, reflecting the broader pound weakness. Conversely, safe havens are shining. Dollar-yen is sitting at 163.566, and gold is at $4,092.70, though gold has pulled back slightly from its highs. The VIX is at 18.58, suggesting volatility is elevated but not yet in panic territory. Several headlines are shaping this risk-off environment. First, Nuker beat estimates, but shares shrugged it off, a clear sign that earnings quality no longer drives stock prices in this climate. Second, crude oil futures settled at 82.61, down sharply, adding deflationary pressure. Third, the U.S. Treasury sold $70 billion of 5-year notes at a high yield of 4.408%, absorbing liquidity but maintaining yield support. Finally, cable sellers pushed the price below the lows from last week, marking the lowest level since July 2. On the Nuker headline, the fact that a beat wasn't rewarded tells us that fundamentals are being ignored in favor of macro sentiment. That shrugged-off reaction confirms the fear and greed score of 14 is driving execution, not corporate results.
I'd also flag the Pakistan intelligence report mentioning limited ground operations in Iran. Even if unconfirmed, geopolitical uncertainty feeds directly into that 14/100 fear score, reinforcing the bid for gold and dollar, while suppressing commodity-linked currencies like Aussie yen at 114.4865.
Regarding the Treasury sale, the high yield of 4.408% on 5-year notes is significant because it reinforces the steep short end of the curve relative to longer durations, contributing to that flattening spread pulse mentioned earlier. This yield structure makes dollar-yen at 163.566 attractive to carry traders, unless they're terrified of the BOJ decision.
Let's start with the biggest tension in the market right now, dollar-yen. It's trading at 163.566, near its 5-day high of 163.988, yet leveraged funds have piled massively into yen longs. Pulse, walk us through the macro divergence here. It's a classic policy squeeze. The Fed is holding steady at 3.63%, despite CPI remaining sticky at 3.46%. Meanwhile, the BOJ is looming on July 30. The market is front-running a divergence. U.S. rates stay high, while Japanese rates might rise. But look at the positioning. Leveraged funds are now net long yen by 1,209 contracts, with a staggering week-over-week jump of 97,394 contracts. That is an enormous shift in a single week.
Exactly, and this is where the danger lies. These yen longs are the largest single-asset weekly flow shift in our data set. Normally, such a crowding event happens after a move. Here, it's happening before. The funds are betting the BOJ surprises hawkishly, but consider the liquidity vacuum. With the fear and greed index at 14, risk assets are thin. If the BOJ doesn't deliver the shock, or worse, if they intervene verbally, that 97,000 contract book becomes a liability. The price at 163.566 isn't supported by spot demand alone. It's propped up by this fragile, crowded speculation.
I agree with CIPHER that the positioning is fragile, but I want to highlight the volatility disconnect. The VIX is at 18.58, which sounds moderate, but paired with a fear and greed score of 14, it suggests a slow bleed. Markets aren't panicking yet, but they are losing confidence. That means dollar-yen could spike higher into the 163.90 simply because there's little buy-side depth to absorb the selling of risk assets. The risk isn't just a reversal. It's a liquidity gap that could widen the 5-day range of 162.668 to 163.988 rapidly.
Technically, the 163.5 area is becoming a resistance cluster. We've seen rejections near 163.988 multiple times over the last few days. Unless we see a decisive break above that 5-day high with volume, the chart structure suggests exhaustion. The upside is capped by the very positioning Pulse described. It's running out of room to run.
Grid, you're looking at the chart, but don't ignore the yield curve. The 10-year 2-year spread is flat at plus 0.34 percentage points. A flat curve usually precedes recessionary fears. If the EFF OMC on July 29 hints at cutting rates due to growth concerns, that dollar-yen level becomes untenable regardless of the BOJ. The macro foundation is cracking, even if the technicals hold for now.
That's true, but right now the technical reality is that dollar is winning against risk assets. The pound is crumbling. Let's move to the second major pain point, cable.
JPY was mentioned earlier, but let's zoom in on cable. It's currently at 1.3354, having broken below last week's lows to reach a 3-week low. Grid, you flagged a structural fracture here. What are the levels telling us?
The damage is done. Cable traded within a compressed 5-day range of 1.32989 to 1.33953 before settling near the lower bound. That 1.32989 level is now critical. It's the exact low recorded on July 23, creating a multi-session horizontal support block that is being tested by active selling. The fact that we closed near the bottom of that range indicates a lack of buyer interest. Momentum is clearly bearish.
But notice the divergence in flows. While the price is dropping, RC leveraged funds are still strongly bullish with a net position of 24,788 contracts. Why? Because speculators think the drop is an overreaction. They're holding onto the carry trade, expecting the RC to rebound. But with the VIX at 18.58 and global risk sentiment collapsed, that bullish RC bet is sitting on top of a knife. The flow data shows they are refusing to exit, which means when the stop losses hit at 1.32989, the cascade could be swift.
CIPHER, you're focusing on Aussie, but this is a dollar story. The weakness in pound isn't just about bad UK data. It's about the strength of the greenback anchored by that 3.46% CPI. The Fed has no incentive to weaken the dollar right now. So, Grid, when you say 1.32989 is support, I'd argue it's a temporary pause. Without a Fed pivot, sterling remains structurally weak against the dollar.
I'm not arguing for a bounce, I'm describing the mechanics. If we lose 1.32989, the next logical extension targets the pre-July 2 levels, likely dipping into the 1,3200s, but for now the 5-day low holds. Traders are watching to see if the price rejects that level. If it bounces, it needs volume. Currently, it looks like a slow grind lower.
And let's not forget the broader context. This pound breakdown is part of a wider risk-off regime. Look at Aussie yen at 114.4865. That's a carry trade proxy. When risk sentiment dies, carry trades unwind. The fact that Aussie yen is stagnant while cable falls shows that capital is exiting risk entirely. The slow bleed SPECTER mentioned applies to the entire risk spectrum, not just equities.
Finally, let's discuss the safe haven bid, gold. Gold is at 4,092.7, having touched a 5-day high of 4,166.12. There's a strange dynamic here. Grid, you see a rejection. CIPHER, you see a short squeeze. Walk us through.
Spot gold hit 4,166.12 on July 22, but failed to sustain levels above 4,100 over the subsequent sessions. We are now consolidating at 4,092.7. Technically, this is distribution. Rallies into the 4,100-plus region are met with aggressive profit-taking. The 5-day high of 4,166.12 stands as heavy overhead resistance. Until we see a clean break and hold above that, the upper bound is capped.
Grid, you're looking at price action, but I'm looking at the ledger. Leveraged funds are net short gold by 540 contracts, strongly bearish. Yet the price is rising to 4,092.7. This is a classic short trap. Physical demand and central bank buying are overpowering the speculative shorts. The divergence is huge. If those 540 short contracts start getting squeezed as we approach the EFF OMC, it could force a rapid move back toward 4,166.12. The institutional positioning is lagging the spot market.
And that lag is dangerous for traders trying to fade gold. The underlying macro driver, sticky inflation at 3.46%, isn't going away. The fear and greed score of 14 means everyone is scared. When everyone is scared, they buy gold. The fact that funds are still short suggests they are betting on a Fed win, but if the labor data, 984K payrolls, shows cracks, those shorts will get crushed. It's a binary outcome.
I'll add a risk note here. Gold is decoupling from traditional correlations. Usually, a strong dollar, trade-weighted index 120.71 pressures gold. Here, gold is holding firm despite dollar strength. This indicates that the safe haven bid is so strong it's overriding currency effects. That's a fragile state. Once the fear and greed index stabilizes, or if equities bounce, that premium could vanish quickly. Monitor the 4,100 level. If it breaks, the safe haven bid disappears.
Agreed. If 4,100 breaks, the next support is much lower. But for now, the 4,092.7 level is a battleground. The bears are defending 4,100, but the bulls are holding the line below it.
We've covered the key tensions. Apex, tie it together. How do these pieces fit?
The overarching theme is policy squeeze meets risk off. Pulse highlighted the macro divergence, the Fed holding at 3.63% versus a flattening yield curve, which creates uncertainty. CIPHER showed us that speculative positioning, particularly in dollar-yen with that 97,000 contract swing, is overcrowded and fragile. Grid confirmed the technical realities. Cable is breaking structure downward, challenging 1.32989, while gold is facing resistance at 4,166.12, despite short squeezes. SPECTER reminded us that the VIX/fear/greed disconnect suggests this is a slow bleed, not a sudden crash, but liquidity gaps could amplify moves. Essentially, the market is waiting for July 29th and 30th to resolve whether the dollar's strength is sustainable or if the positioning will reverse violently.
Key takeaways. The US dollar remains dominant amidst a fearful 14/100 sentiment score. Watch cable closely at 1.32989 for a potential breakdown, and monitor dollar-yen's 163.566 level for signs of the crowded yen-long squeeze unraveling. Gold holds at 4,092.7, caught between physical demand and bearish institutional flows. tomorrow. Keep an eye on any pre-EFF OMC commentary that might shift the narrative from steady to hawkish or dovish. Thank you for listening to ShadowQuant Forex Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.